You have two choices: spend 10 years losing thousands of dollars trying to figure out the markets like I did, or spend less than 10 minutes with me and let me show you how to stop the bleed. In this particular case, what you're looking at is a bit of an uptrend on the 1 minute chart. When you have a swing formation on the 1 minute chart, in this case looking here, 1, 2, 3, upon the close of this candle, this next one opens at this price here. Let's do a quick calculation for how far the market pushes before it begins to retrace. So measuring from this point all the way up to this high point here, you have 3.9 pips. But now let's take ourselves over to, say, the H6 chart, in which each of these bars is worth 6 hours of price action. And we're going to take a look at another swing low, 1, 2, 3, where you have the middle candle with the lowest low. Once this candle closes at this point, the next one opens up here. So measuring from this point here all the way to the next peak that we get before the retracement, you can see that we get at least 30 pips of movement. Immediately, it should be obvious to you why you want to look at the higher time frames first. It does not matter if you are a scalper working with the 15 minutes or the 5 minute charts. You should always look at the higher time frames because that is how you will determine your bias as well as your exit point. It does not make sense for you to scalp in the middle of nowhere, not knowing that you're running into a structure that may eventually lead to your downfall. So let's take a look at this example over here. You have 1, 2, and 3. Notice how this candle here in the middle is not just the middle candle of the swing, which is a bearish swing in this situation, but has completely engulfed this candle here, where my cursor is. So the strong bearish push followed by the close of this candle, which completes that bearish pattern, tells you instantly that you can expect the market to push down for a significant amount of pips. And in this case, you can look to target this recent low here, which is 7.7 pips, admittedly not a lot, but then you also have this low here, which is 24 pips. So let's go and take a look at exactly what happens on a lower time frame. First things first, I will mark off the high point and the low point of this swing. So let's do that right now. Over here and there. Let's move this over here as well so there's no confusion. And then I will be putting a vertical line for you to see exactly where the market opened after creating the swing, which is over here. And then I will be putting a horizontal line so there's no confusion about the exact price point at which this candle here opened. Let's go to a lower time frame. Now we are on the 5-minute chart, which is going to zoom all the way back. And this is exactly where that candle opened. Because the market created a swing formation that was bearish, and because of the intensity of that middle candle's push to the downside and how it engulfed the first candle of the swing, you can anticipate a bearish push. So when you have the break of a swing low to the downside, that could be the signal you need to get in. The simple break of that structure, which happened with this candle here, at this close, could be all you need to get into a trade on this next candle which opens here. Your stop loss would be at the most recent swing high, and then you'd look to target down here. This is a stop loss of about, let's say, 3 pips because you need to consider the spread, and then your take profit would be all the way down here for about 13 or so pips, which is pretty generous if you ask me. Alternatively, we can return to that 6-hour chart to be certain exactly what it is we want to target. So that you can see what I'm talking about, I will move this vertical line away. Once you've figured out exactly where it is you're getting in, you would have to ask yourself, where would you be getting out? You could target this low over here, so automatically that would give you a little more than your 13 pip stop loss. Now you're probably wondering, well, what do we do about the fact that the market eventually did open here and come back and take you out of the trade if you were still in it? Well, first things first, look over to the left. That didn't happen. You first got your take profit hit. But if you were holding because you were expecting even lower prices based on the intensity of this push over here, from this point to this point, what can you do? This is where it's very useful again to stick to the high time frames. You can mark the high and the low of the most recently formed 6-hour candle, which I've done like this. The next thing you'd have to do is drop down to a lower time frame. This is the entirety of all of that 6-hour price action. Let's see what happened when the market broke back above. Once it did that, it pushed all the way up here. Let's zoom in so you can see closer. We have this upward push and then we have this retracement. The market failed to break above this high, dallied here for a bit before we had a strong push to the downside, breaking this low here definitively with a strong close rather than just wicking through it. The next bar opens and then pushes down. In the process, it leaves behind something some of you may be familiar with already, which is a fair value gap. And you can see how you could have a pending order here with your stop loss above the second candle or above the entire swing itself. And your take profit would be determined based on different factors. You could target these relative equal lows here, Or you could go back to the 6-hour chart and ask yourself exactly what it is you expect should be targeted. You can expect the market to take out this low of this candle here. Now, why exactly would you be expecting that? Excellent question. Take a look over here and you'll notice something else happened when that swing was in the process of forming on the 6-hour chart. It left behind a fair value gap, and it is this fair value gap that the market actually tapped into and then rejected. Remember, if you're trading on a higher time frame, you can expect the movements to be a lot more dramatic and to yield a lot more pips than you would receive on the lower time frame. So it makes sense that if the market is rejecting this fair value gap, the next stop should be a low, which is the most recent one down here. If you found this video helpful, go ahead and give me a like and a follow because I'll be dropping more content like this to help you improve your trading and stop making your broker rich.